Getting a mortgage through a business or LLC is possible, but the process is more complex than obtaining a personal home loan. While this option offers certain advantages, it also comes with significant limitations that every business owner should understand before proceeding. Yes, your LLC can get a mortgage, but loan options are more limited compared to individual borrowers. Most traditional residential loans with favorable terms are simply not available to business entities. This reality forces many business owners to carefully evaluate whether purchasing property through their company is truly the best approach. Consider this example. One business owner investigated getting a mortgage for his LLC, only to discover that obtaining a loan with a competitive interest rate wasn't possible. While he could have purchased the property using his company name if paying cash, like most small business owners, he lacked the funds to buy outright. Instead, he purchased the property in his personal name, using traditional financing and adding insurance protection. Why did he make this choice? Traditional loans offer the lowest available rates, lower down payment requirements, and long-term fixed financing. These loans have these favorable characteristics because they're supported by the federal government and can be sold to government-sponsored mortgage companies like Fannie Mae and Freddie Mac. However, these conventional loans cannot be awarded to an LLC. They're only available to individuals or living trusts. When lenders consider issuing mortgages to LLCs, they examine several key factors. Business credit score and history matter significantly, with most lenders requiring at least 2 years of operating history and good business credit. Personal guarantees are often mandatory, making business owners personally liable if the company defaults. The property type and intended use also influence lending decisions. Residential rental properties typically receive more favorable treatment than mixed-use or commercial properties, which lenders consider riskier. Down payment requirements are substantially higher for business mortgages, often ranging from 20 to 35% compared to the much lower requirements for personal loans. Lenders will scrutinize your LLC's cash flow and financial documentation, requesting profit and loss statements, tax returns, bank statements, and operating agreements to verify financial viability. These stringent requirements mean that while LLCs can technically get mortgages, not every business will qualify. Although traditional residential loans aren't typically available to LLCs, several alternative financing options exist. Commercial real estate loans are designed specifically for business use properties and are offered by banks or credit unions. These typically have shorter terms of 5 to 20 years and higher interest rates than residential mortgages. Portfolio loans provide another option. These are issued by lenders who keep the loans in their own investment portfolios rather than selling them on the secondary market. This arrangement allows for more flexible underwriting criteria and customization based on your business's financial profile. Asset-based loans focus primarily on the property's value rather than your credit history, making them useful for businesses with limited credit history but significant assets. Hard money loans, provided by private lenders based on property value, work well for flipping properties or situations requiring fast closings, though they come with higher interest rates and fees. For rental property investments, understanding your limitations regarding available lending options is crucial. Research lenders who are investor-friendly, as credit requirements become stricter when you have multiple loans. Ensure you have sufficient working capital, as cash reserves are typically required. Fannie Mae allows individuals to have up to 10 loans simultaneously. Working with knowledgeable lenders helps you develop strategies to maximize this limit. Most banks won't extend more than 4 loans to a single borrower, so finding lenders willing to approach that 10-loan ceiling may require research. When building a rental property portfolio, assembling the right team is essential, particularly choosing the right lender. Direct lenders often provide more control over the borrowing process than mortgage brokers, which is valuable when developing an investment property portfolio. To improve your chances of mortgage approval for your LLC, build business credit by opening business credit accounts and maintaining reliable payment history. Keep organized financial records showing profitability, maintain separate business bank accounts, and prepare a solid business plan explaining your long-term strategy for the property. Working with lenders who specialize in real estate investors or small businesses can also improve your odds of success. Purchasing real estate through an LLC offers both advantages and disadvantages. On the positive side, it provides asset protection by limiting personal liability in legal claims or debt collection. It offers tax planning flexibility and presents your rental activities as a legitimate business, potentially benefiting future partnerships. The downsides include higher interest rates compared to personal mortgages, larger down payment requirements typically ranging from 20 to 35%, fewer available lenders, and increased administrative complexity from forming and maintaining an LLC. Some property owners choose to purchase property personally using traditional financing and later transfer ownership to their LLC. While this approach can enhance asset protection, it comes with risks. Most mortgage agreements contain due-on-sale clauses, allowing lenders to demand full loan repayment if the property changes hands. Though rarely enforced, this remains a legal risk. Additionally, transferring property incurs costs like recording fees, transfer taxes, and attorney fees. Insurance policies must be updated to reflect the LLC as the new owner, potentially affecting premiums and coverage. In some cases, obtaining formal lender consent before transferring can mitigate these risks. In summary, businesses and LLCs can obtain mortgages, but with more limited options and complex requirements than individual borrowers. Commercial and portfolio loans represent common paths for business financing. While forming an LLC offers liability protection and tax advantages, it typically means accepting higher interest rates and down payments. Working with investor-friendly lenders and legal counsel can significantly improve outcomes when pursuing this financing strategy.